All right, chapter 18. There should be something in Blackboard, the Unit 3 study guide. The most important part of the study guide is the second page of the study guide. This has got all the formulas that you need for chapter 18 in one place. Very convenient for you for doing the homework, the quizzes, and the unit tests. This chapter is full of formulas and they're scattered throughout, so I thought I'd make it easier for you by putting them all in one sheet for you. This chapter is a departure from determining costs. In this chapter, we're going to talk about the types of costs that we have as a company and some various ways to work with those costs and produce reports that are valuable for managers. Cost, volume, profit analysis. Cost is what something cost us, of course. Volume is how much we produce. And the profit is, of course, our profit, sales minus cost of goods sold. Some of the things we're going to do in this chapter is, answer some questions. Like, if we install a new machine, which will help us reduce labor costs, oftentimes a machine can do things cheaper. But how much cheaper? And then, another example of a question that this chapter might answer is, if the selling price goes down, what's going to happen to our net income? Or in this case, if we lower our prices, oftentimes we're able to sell more. But what's the sweet spot? If we lower our prices too much, we're certainly going to sell a lot, but will the increase in sales volume make up for the lower sales price? So these are all things we're going to analyze today. Sales mix is another thing we're going to discuss. Like, if we have more than one product, what's our ideal mix of sales? So just to summarize, which I think you've already learned, fixed and variable costs. Okay. Fixed costs in total, see the word total, don't change. From month to month, they don't change, no matter how much we produce. This is our volume, how many we're producing. So whether we produce 200 units of product or 2,000 units of product, you can see our fixed costs remain the same. However, and fixed costs are like usually our fixed overhead, like the rent on the factory building, the supervisor's salary, which is the same every month because they don't get overtime. Now, variable costs are in the orange line here. As you can see, if we produce no units, then we don't have any variable cost. Now, variable cost is direct materials, direct labor, and your variable overhead. But the more we produce, obviously, the more we have to spend to buy those materials, pay for the labor, etc. So those go up as our volume increases, as the more we produce. However, per unit is a whole different story. So think about this. If our fixed overhead is $1,000 a month, our factory rent is $1,000 a month, and we make one product, how much of that rent is going to be allocated to that one product? In other words, that rent helped us make one product. But if we made 1,000 products, then that $1,000 of rent could be split amongst the products, the number of products. So if we made 1,000 products, we're only allocating $1 of rent to each product. So our profit per product goes way up. The point is, here's our fixed cost. If we make like 150 products, but the more we make, the rent goes down per unit. The fixed costs go down per unit because it's split up amongst more units. Look at the orange, variable cost per unit. It doesn't matter if we make 200 or 2,000. Per unit, the materials are such and such an amount, and the labor per product are such and such an amount. This first method here is, I don't know, I've never found this useful in real life. but it's something in the book, and I guess it could have its uses. I've yet to see them, but this is a problem solving issue here. Every month, and how many units we produced each month. So look, in January, we produced 27,500. But in February, production went way down, right? In May, we're through the roof. We're at full throttle doing 47,000 units during May. Drops back down a little bit, but picks back up October, November, December. So this is our production for the factory. And the total product costs are here. And obviously, the more we produce, take October, 67, those are our costs, 29,000. But in the month of February, when we produce very little, it's only 20,000 of costs. Now, total cost equals fixed cost plus variable cost. And this is the total cost. I'm telling you that some of this is fixed cost. It doesn't change month to month. There's some amount in here that's the same no matter what. The reason these are going up and down is because the variable cost and because we're producing different amounts. But embedded in these numbers is a static number from month to month of fixed cost. And your goal is to estimate what our fixed costs per month are. Given that information, we can apply the high-low method to estimate fixed costs. And here's the formula. We take, it's called the high-low method. So we take the highest activity level and the lowest activity, high, low, and we write them down. So in October, if you refer back to this, was our highest month of production, 67.5. And our lowest was February, 17.5. And then beside it, I put the costs associated with those months. October, 29, February, 20,500. October, 29, February, 20,500. So put the costs associated with these months next to it. And now we can use our formula. The difference between the high and low cost divided by the difference between the high and low units, 8,500 and 50,000. This gives you variable cost per unit. So now we're getting closer to our answer. We know that the variable costs per unit are 17 cents per unit. And now remember the formula I just told you. Total costs equals fixed cost plus variable cost. Now let's remember our algebra. If the total cost is that, and we know the variable cost, right? We just figured it out, 17 cents per unit. And we know the total cost for each month. We can figure out what the fixed cost is by solving for X. And this is X right here. So you pick either the high or the low. It doesn't matter which. In this case, I'm going to pick the high, but I could have picked the low. Doesn't matter. And you put your total cost here. We don't know the fixed cost because that's what we're trying to find. Plus the variable cost, the total variable cost now. 17 cents per unit times how many units? Well, it's right here, 67,500. So that reduces down to 29,000 equals fixed cost plus these are our variable costs for the month of October. This is my total cost for the month of October. So our fixed cost must be 17,525. So I know every month my fixed cost is 17,525. I know that of these numbers, 17,525 is embedded here as a fixed cost. The rest is variable. So pretty neat, huh? Now we're going to go and do number 3 in the chapter 18 practice, the high-low method. So again, we're going to use our formula sheet, right? Because it's there for you to use. So the high-low method's right here. Step 1, identify the period with the highest volume and the lowest volume. So let's do that first. What's the highest volume month? November. And the lowest is December. Cool, they're right next to each other. Now, what's our formula? What do they want here? See, this is the formula. Difference between high and low cost divided by the difference between high and low volume. So cost is in the numerator, the volume is in the denominator, the difference. Now, cost at the high point minus cost at the low point. That's the difference in cost. Volume is the volume at the high point minus volume at the low point. It's the difference between the two, right? So again, as far as cost goes, the difference between 8,100 and 3,600 is 4,500. So 4,500 is the difference there. So I put that in. And as far as the volume, the difference between these two numbers is 240 minus 60. That's 180. All right, and now my variable cost per unit is $25. Now I know that these things cost me $25 per unit in variable cost. I don't know what the fixed costs are yet, but I'm going to find out. Total cost at the high point was 8,100, as it says right there. The variable cost at the high point, see the colon consists of this. The variable cost at the high point. So the volume at the high point was 240 for November, right? And the variable cost per unit, we figured it out already, it's $25. So the total variable cost would be, obviously, if it's 25 per unit times 240 units is $6,000. Total cost at the high point is 8,100. I typed it wrong. Yeah, my total costs are 8,100, but of that, 6,000 is variable. Therefore, the fixed must be the rest of it, which is 2,100. You don't really have to do this in the real world, but we're going to do it anyway because they want us to. We're going to get 2,100 again because the fixed costs don't change every month, right? Total cost at the low point, 3,600. Volume at the low point, 60. And again, the variable cost per unit is $25. We already figured that out. 60 units times 25 a unit is 1,500. The variable. Total being 36. The variable is that. So the rest of it is fixed. That's total minus variable equals fixed. Notice they're the same. No matter which month you do, you're going to get the same number because the fixed costs are the same every month. That's why they're called fixed costs. Let's go to a very important concept in business management. You all may remember that sales minus cost of goods sold is gross profit. That's an important number. But another important number that people also want to see sometimes is called contribution margin. That's kind of a funny word, and I'll attempt to explain why they call it that in just a second. But contribution margin is your sales, like your revenue from selling the stuff, minus only the variable costs. You know, we sell this thing for $100. The variable costs are 70. So our contribution margin is 30. So contribution margin is kind of like an incomplete profit. You know, it's not the whole picture. It's just the minus the variable costs. So it says here, the contribution margin is the amount from each sale that contributes to covering our fixed costs. So let's just do a problem. Number 4. And we're going to calculate the contribution margin. So again, contribution margin, as you learned, is sales minus variable cost. And I think less. Sales minus variable cost. Our sales are 5,000. Our variable costs are 3,000. So our contribution margin is 2,000. Another formula you might need is your contribution margin ratio. The percent sign means ratio. contribution margin percentage, contribution margin ratio, same thing. And that's your contribution margin divided by your sales. And because of the rules of math, you could rearrange it like this. So the contribution margin ratio, again, is contribution margin divided by sales. And our contribution margin we already calculated is 2,000. Our sales are 5,000 as given to us. So that's a 40% contribution margin ratio. Out of our sales, 40% of that is 40% of our sales is contribution margin. It's going to help cover our fixed costs. I don't know what they want here. Fixed costs, I guess. How would you figure out what our fixed costs are? I didn't put the formula here, but hopefully you can kind of figure this out. Sales minus fixed and variable costs, minus all your costs, right, is your net income of 400. So sales minus fixed costs and variable costs, right, equals my net income. My sales we know are 5,000. Fixed costs we don't know. Variable costs we know are 3,000, right? And we know our net income is 400. We can kind of solve for X there, can't we? 5,000 minus 3,000 is what? 2,000. So 2,000 minus what's going to get us to 4,000? 1,600, right? Now this one, this is kind of like a brain teaser. Basically, selling price minus variable cost equals contribution margin. 20 minus 16 is 4, right? That's easy enough. And then you can figure out this using your formula sheet. But what about this? What minus 30 equals 10? Well, 40, right? So this is like a kind of like a puzzle you're solving. 40 minus 30. So what minus what equals 50? This could be anything, right? However, we know our contribution margin ratio is 20%. And if we go to our formula sheet, contribution margin ratio is 20%, right? Use your formula. 20% equals 50 divided by what? Or you can use this formula, but just solve for X, okay? Now, the next one we're going to talk about is our break-even point. Now, break-even point is nice to know. Your break-even point is basically at what point is our net income 0? That means we're breaking even. It means our revenues or our sales are exactly the same as our costs, you know, fixed and variable. Break even is not the goal, although it's nice to be able to break even. We want to do better than that. You calculate the break even point by using these formulas here. So we sell a waterproof phone case for $90 per unit, fixed cost, variable cost. Okay, so our information's there. So the first part, they wanted to determine contribution margin. So again, contribution margin is sales minus variable costs. Sales are 90 per phone. Variable are 36. 90, 80, 70, 60, $54 per unit is my contribution margin per unit. Now to get the break-even point in units, you take your total fixed cost divided by the contribution margin per unit, as shown on your formula sheet. Total fixed costs are 162. Contribution margin per unit is 54, as we already figured out. All right, big deal. What does that mean? It means we need to sell 3,000 units of product in order for us to break even. So this is really a nice little thing you can do to maybe give sales goals to your salespeople. We need to sell 3,000 units to break even. We'd like to sell more though, wouldn't we? So we can make a profit. But this is just to break even. Now, what if we need to know our break even dollars? This is the amount of dollar sales we need to achieve to break even. I mean, same basic premise, except here our answer will be expressed in dollars. Instead of number of phone cases, it's revenue for all the phone cases. So how much sales do we need to have to break even this month? Well, again, sales minus variable cost is contribution margin. So sales are 90, variable cost 36. So our contribution margin is $54 per unit. And the contribution margin ratio, which obviously to get our break-even point in dollars is total fixed cost divided by contribution margin ratio. And you can refer up to here for the contribution margin ratio formula. It's contribution margin divided by sales. So see how all these formulas fit together? So the contribution margin ratio is contribution margin divided by sales. So 54 is our contribution margin per unit. And we're selling these suckers for $90 each. That's a 60%. This number, this contribution margin is 60% of our selling price. And to get the break-even point in dollars, you use this one. Total fixed costs divided by contribution margin ratio. So fixed costs are 162 and contribution margin ratio is 60%. Our sales need to be $270,000 in dollars, which does translate to however many units that was, right? In the last problem, 3,000 units. What's 3,000 times $90? 270,000, right? See, 270,000. Be careful because in your homework, numbers 6 and 7 don't have the same numbers as each other. These will be different. So that analysis won't hold water in your homework. And here's another example of how to calculate the break-even point, except they don't give you a little chart to fill out. They just give it to you here and ask for the answer. This is something like you will have to do in the quiz, because in the quiz, you know, it's a question like this and then some multiple choices. Break-even point in units. Total fixed cost divided by contribution margin per unit. There's our total fixed costs. Do we know the contribution margin per unit? We do. It's sales minus variable costs. So the contribution margin per unit is 175 minus 116. You're going to plug that into the denominator and put your fixed cost in the numerator to figure it out. So that's all I'm going to say about that one. A contribution margin income statement is just a special kind of income statement where we put contribution margin in the middle. Your traditional income statement had sales minus cost of goods sold equals gross profit. Well, here we're just going to start by taking out variable costs to give us our contribution margin. And then we go and take out our fixed cost, and that will give me my net income. So it's just a more detailed form. We still get to the same number. We're just taking out a variable cost up here and our fixed cost down here. So my sales are 10,000 units. Well, what do we sell each unit for? $175. So $175 times 10,000 units. The variable costs are 116 per unit. I can't do that in my head. 116 times how many units did I sell again? 10,000. All right. Now the fixed costs are just the fixed costs. It's given to you as 354. So that's my net income. All right. So the point is the contribution margin income statement is just, it ends up the same way. It's just the way it's arranged. Now the break-even point and margin of safety. Now recall that the break-even point is, you know, how many we have to sell to break even to end up like with zero net income. The margin of safety is, it's the sales we want to earn over and above the break even, like a cushion or a safety net. So as you might expect, the margin of safety is, you know, what I expect or hope to sell minus what I would need to break even. And here they want the margin of safety in units, I guess. Let's just try to figure this out. what's the break-even point in units? So look back at your formula. Fixed cost divided by contribution margin per unit. Fixed costs are 175. The contribution margin per unit that's $50 per unit. So that's my denominator. So if I take 175,000, which is my total fixed cost, 175 divided by, what was it, $50 a unit? It's 3,500 units. I've got to sell 3,500 units to break even. Oh, I want the margin of safety in dollars. Okay, so the margin of safety in dollars is total expected sales minus total break-even sales. So what are my total expected sales? Total expected sales, $340,000 given to me, minus my total break-even sales. I got to sell 3,500 units to break even, right? And we'll sell this stuff for $85 per unit, right? Yeah, 297.5 is my break-even sales. So if I just subtract the two, I'm going to get 42,500. All right, and that is called margin of safety in dollars, obviously. All right, Zulu sells phone cases for 90, fixed cost, variable cost. Okay, compute the units that must be sold to get a target income. This is like, how many units do we need to sell to get our desired income? Compute the units that must be sold to get a target income. Unit sales at target net income. Total fixed cost plus target net income divided by contribution margin per unit. Do we have this information? All right, fixed costs, we got them. Plus target income. Target income right there. So 200 plus 216 is obviously 416,000. Contribution margin per unit, 90 minus 40, so it's 50. All right, so I need to sell 8,320 units in order to end up with 216,000 of net income. All right, guys, thank you.